Some of the things that we want to discuss when we're looking at the consumer, we want to look at debt. Obviously debt is much cheaper. It's a bit easier to carry some of the costs. But when you look at credit card balances and other revolving credit, you're just seeing how quickly we're getting that balance back. And given we're not back to where we were, but think about how much of that debt was paid down because you had government subsidies coming in, you had government support, and now that is gone. So now as people have drained or dwindled what was in savings, this is, I think, a very good bellwether of how much are people looking to spend, and you see how quickly we're getting this rebound. And the pressure is really because there's not that amount of savings, wages aren't keeping up, and now you had all of this progress that is being lost as more credit is being used to maintain their living situation. And then when you factor this out and look at household debt in general, household debt expanded to $15.58 trillion in 4Q of 2021, and you're getting the breakdown of where. So yes, the cost of the mortgage has fallen, but the mortgages have also gotten bigger. And I think you're starting to see that again kind of branch out and become an overarching problem when you're looking at, okay, well, where does this go? What happens if the price of the homes fall as mortgage rates go up? What happens as taxes go up, especially on real estate and property taxes, like how is that going to eat into what you spent? Now, if you're going to live in that house for the next 40 years, it really doesn't matter. It's just for people that are trying to buy and flip, buy and live in something for 2 years and then try to get out, you're starting to see, I think, some of those pressures. So then the credit cycle is rushing towards a slowdown phase. And the reason why is because you're just getting these indicators. You're getting a lot of this pressure in terms of, well, financial conditions are going to go up, are going to get tighter. Why? Because rates are going up. So that's going to see this bigger pivot. And then are you going to start to see people coming out of the riskier assets, the unicorns, the ones that really need capital infusions consistently to maintain their growth? And I think the short answer is yes. And here's one of those driving forces on why that's happening. It's just on the inflation front. So here you can see, we came in at 0.6%. Then you take out less food. So the 7.5%, the pressure points, just as kind of rehashing what we talked about before, this is a bigger problem, which is what is being addressed and what they're trying to go after in terms of bringing rates up and again, adjusting some of those flows. So then when you look at wages, this is where wages continue to go up and create that pressure. So when you look at where wages are headed and how wage pressure is moving up, that's why we continue to see some of these movements as wage growth and median CPI at 4.2% and counting. That's, again, that sticky side because wages don't just collapse. Once you're paying someone that money, you don't bring them in a week later and say, by the way, I'm taking 10% away. That's where you're going to have to let people go and then try to hire someone back at a lower wage. That's that stickiness that remains in some of these companies. But when you look at the U.S. debt, it's important to look at the breakdown because mortgage debt alone is up almost $1.5 trillion since the pandemic started, and it's on the back of low rates. Now, when you read what the Fed came out with in their Fed minutes, they're talking about actually not only just letting the MBS or mortgage-backed securities roll, but actually actively selling them. And I think there's more concern around where the real estate market is and what that looks like. So that could easily put some of this mortgage debt under pressure when you look at equity value and what that is going to look like over the short term. In the meantime, median sale prices remain at 13.9% year over year. So the comps get harder. So just year over year basis, but you're getting an idea of, things are still elevated, still a lot of froth in the market. Median asking price is up 14.9% year over year. So asking price continues to go up. But where the transaction is happening is slightly below. So you're not getting the same type of bidding wars where people are putting out an offer and they're essentially not bidding above that because you've seen this increase and there's really essentially you're coming in at fair value already or what the market deems as fair value. Mortgage payments on median asking price is up 25%. So even though rates are down, the mortgage payment is up. And that's the conundrum because even though rates are low, people are buying more house. So if they could afford, $2,500 a month, they're going with that and above because they want the additional space. So you're seeing, again, this is why the mortgage payment becomes a problem, especially if we start to see property taxes going up and other types of costs that could actually bring down the value of the home, putting some of these mortgages under pressure. Now, while that's being considered, the pending sales are down 0.5% year over year, starting to get some of that slowdown. New listings of homes is down 10%. So you're starting to get, again, the kind of the leading edge of some of these slowdowns, while at the same time, 3% of listings had price drops. So now you're starting to see price drops. You're starting to see this come down a bit. Again, we're still elevated. We're still at these high points, but you're starting to see some of that normalcy when you're looking at prices actually coming down and not seeing these big bidding wars. And then the mortgage costs as share of income for the first-time buyers hits a 3-year high. So again, you're seeing these pressure points in terms of who's your next incremental buyer. How is this individual going to come in if they have to compete against someone that can put 50% cash down and they're going to put down 10% and need PMI? Again, these are some of those incremental buyers because everybody that could buy a house has bought a house. So how are we going to see that expansion continue? So then when you look at the median U.S. home selling price is 99% of list, again, seeing on an average prices actually coming in slightly below in terms of where that is. And we expect that to continue to see that drop as again, that incremental buyer remains a bit tough. But this is interesting when you look at mortgage payments, interest rates, and loan sizes. So when you look at 2022 loan size at 2019 rates, you get an idea of the pressure that can come into that new home buyer and what that equity value is going to look like as that pressure continues to ratchet higher. And then when you look at what percentage of price increases would from what you budgeted would make you reconsider your home renovation, and you're seeing that 10 to 12% is really that pivot point where people are like, no, can't do it now. Now, smaller projects, there's much more, is a bit more less flexibility. But when you look at the small to bigger projects, that's where people are like, look, 10% is just too much. I'm now priced out, and I'm going to wait. So there is going to be that backlog of activity on home renovations because people are like, look, I can't afford it now. I'll wait 12 months and hopefully prices will get better. And this is essentially saying they'll get better, but not where you expect them to be, kind of given where some of these delays are coming in. So then single family rent increases are setting new all-time highs, again, feeding into that pressure when you look at the pricing metrics and when you look at that sticky inflation that's going to remain kind of in that underlying system and where we see some of those pressure points in general. So then when you look at the National Association of Home Builders Market Index, confidence ticked down to 82, but that was the estimate. So again, there's still a lot of confidence out there, but you're starting to see some of that slipping and some of those leading indicators that are showing that things may not be as good. But again, this is February. We really have to make that call as we get into spring and summer, the key periods or the prime periods for home buying, and really what does that look like as we go through the remainder of summer. And then when you look at industrial production, stronger at 1.4% versus the estimate of 0.5. Factory production, again, everything's looking a little bit better, trying to create some of that backdrop. A lot of it was driven by utilities, which were up 9.9% versus being down negative 1.8%. But still, there's a lot to catch up on when you're looking at industrial side, but it's how does that manage to protect against some of these price increases. Now, the jump higher in inflation and slight tick higher in unemployment rate has sent the misery index back up. It's now at the highest since pandemic began. So the misery index is just another way to look at, again, falling sentiment, falling, wages not keeping up, and just where people are seeing their prices. So then buying conditions, not surprising, University of Michigan showing that buying conditions for vehicles February continue to get worse, more pressure, where for homes, it's the worst on record. And for vehicles, it's the worst on record. And for homes, it's right near the lows from the 80s. Now the adjusted sales. So yeah, the retail sales, just looking at retail sales but that recovery is muted when you put it into the backdrop of inflation, which is why you're going to get more pressure based on what we're talking about with rents. So then when you look at rent, you can see the National Single Family Rent Index, the even low end rent prices were up 11.2%. So you have your wages going up 5%, you have your rent going up 12%. Then you have food going up another 12%. How are you managing this? And that's where we see the increase in debt, the increase in credit card risk, and that's again that leading edge of where some of this pain points really hits consumers. The core goods with CPI still spiking higher, 11.7% year-on-year rate is faster than the 1970s. Core services, orange, though, ticking up, but not yet expanding at the similar rate. And again, that's where we see that catch up, which is going to put that underlying pressure on consumers, on the underlying buyer. And then this is just looking at food at 7%. So again, this comes back down to where are retail sales really when you adjust for volume, given the fact that food is up 7%? What does the retail sale look like given the fact that prices are up? So that's the volume versus value that we keep driving home. So then wholesale inventories continuing to show strength, up 2.2% in December versus the 1.7% in November. And again, you're seeing a lot of those pressure points shifting higher, which is again moving things up. And this is going to be a net positive for Q1. A Q1 driver for GDP as inventories is a bullish backdrop. But how much of that is going to be countered from retail sales coming down and again putting some of that pressure there? Now, one of the things is the historical look at core goods minus core service inflation with the recessions. The spread is more negative now than at any point going back to the 1950s, which just speaks back to the pressure points we continue to see on core goods, core services, and the prices that are being experienced in the market. And again, not all things are equal because the cost of living was always higher on the coast. So when you look at New England, when you look at the West Coast, the rate of change isn't going to be as aggressive as other places that are being subject to diesel prices, shipping costs from the coast to bring in imports. That's where you're seeing some of the biggest problems, which is hitting the people that, again, are used to a lower cost of living, that are seeing the most rapid change, which again is going to hit that retail sale and the consumer spending and what economic growth and what the economy can achieve in 2022. So this is just looking at average hourly earnings. When you look at it on the hourly, minus 1.7%, weekly down 3.1%. This is again, this is factoring in inflation and those pressures that continue in the market. Average hourly earnings, again, just showing you wages still getting hit by real average earnings, down 3.1%, and in January down from 2% in December. So that pressure point, and until we get that movement, which again comes back to avoiding the wage spiral, trying to get ahead of this, which is why we think that the Fed is going to maintain a bit more of an aggressive stance to try to offset. This is just looking again at total Michigan consumer sentiment as you continue to see it drop as expectations coming worse. We're now well below where we were in 2020 and just seeing some of those pressure points again leading to that misery index. And even as this is happening, again, the view on an inflation rate is still a bit muted going out 3 years. The problem is I think you're going to see that turn back up as you get wages not keeping pace and really the cost of rent and that owner's equivalent rent catching up and creating a bit more of those problems. And then looking at U.S. inflation already at the highest in decades, which is poised to accelerate. The acceleration is what we don't think happens to the same level, especially in February. It'll obviously come down to where are crude prices, gasoline, diesel on the flexible side, as the sticky remains the piece. But we do expect some pause in February before we get more of a reacceleration in March through June on the back of rising wages. And this is just what we're discussing on ISM price index. So when you look at inflation may have peaked, you're talking about the headline as the manufacturing side and the prices index has kind of gone sideways. The problem is there's still that disconnect on, again, that stagflation give, which is what we see happening going forward. And this is just another example of more of a stagflation backdrop and less of a grinding inflation side. Then when you look at ISM, manufacturing PMI peaked in March of 21. Some are using this as a sign of conditions will get worse. But when you look at roughly 40% of the decline is a function of faster delivery times. And this is what we've been talking about on deliveries. And that's why when we had this huge surge, we kept saying timeout. Like, we have to adjust this for delivery times. And once you back some of that out and sort of normalize it, you get an idea of that we were really not as high as we were. But you're still going to get some of that normalcy, and we're not going to get this deeply negative number, but something that is just slightly expansionary, which again, this is then looking at, well, but how is the consumer looking at this? An expected increase in household income in 1 year has dropped, and that's another pressure point that remains, and the expected change in financial situations in 1 year time is at the lowest going back to 2015. So if you see this happening, how aggressive are you going to go and take an extra vacation and have some of that discretionary spending that you have been expecting and hoping for? And those are things that we think are going to weigh on the broader theme of spending and again, crude demand as we go into the summer months. And then the expected change in business conditions has obviously gotten worse, the lowest going back to 2015. And that's really, are you going to be able to continue to hire and raise wages? And again, those are some of the underlying problems that continue to persist throughout that whole period. So then when we look at what is happening on the U.S. trade side, the trade deficit just narrowly escaped the record in December of $80.7 billion versus $83 billion estimate. Still very low. Imports are coming through, and these are some of the underlying pressures that remain in the system. The share of Americans who say it'll be a good time to buy a home hit an all-time low of 25% in the monthly Fannie Mae survey, so slightly different. In the January survey, 69% of respondents said it is a good time to sell, an all-time high in the series that dates back to 2010. So again, who's your incremental buyer as the pressure continues to rise on the person who would be purchasing? Small business optimism fell to 97.1 versus 97.5. The optimism continues to wane, still elevated, but when you look at general business conditions starting to flatline, but still not really accelerating as there's that concern on where inventories are and where costs will be, coming back to, again, inflation as being the most important problem. So as long as this continues to be a big problem, that's going to eat into where is sentiment, where is investment, and how much growth we see coming down the pike from the small business mindset. They still see higher prices. They've been pushing that through. And right now, poor sales still are not an issue. But as those prices continue to go parabolic, as that hits into sales, that's when you're going to see that peel back. And that's going to be the period that you're going to see the increase in stagflation when those higher prices can no longer be passed on as volume gets hit. And then it's going to be the volume versus value game. Now, when you look at goods inflation will ease, this is just kind of showing you that conceptually and visually where we see the connection between where are goods going, where are services, goods prices coming down as services continue to ramp up. But U.S. consumption is back on the pre-COVID trend, but it never got back to the pre-2008 trend. And again, this is when you look at just the value of the dollar, the value of wages. We haven't really had much growth since 2009, as you can see with the velocity of money calculation. So even though we're back to the pre-pandemic trend, and again, this is the, why are we not getting back to the earlier one? Was it never attainable? Was it never sustainable? Very possible. But this is where we start getting into what is the economic growth we can expect. And then when you look at high inflation, lower real employment costs, that's when you start looking at the actual hit and where some of the pressures are going to continue to arise as we look at how much are people going to have available to spend. And then as the unit labor costs continue to go up, that's when you start getting, well, if I have to pay these people more, does it make sense to automate? Are we going to get more capital investment? And that's something that is a very very likely possibility. Average hourly earnings by industry, leisure and hospitality. It's just not surprising to see a lot of these increases in general when you look at the hourly earnings by industry continuing to go up. But that's where, especially the leisure and hospitality side, last year there was a ton of deals. Stay 4 nights, get the 5th free. It's 40% off if you go through here. Those deals are getting fewer and fewer, or not as good, because of these prices, which is why, again, we think it eats into where demand is going to be, even though everyone's kind of expecting this surge. Change in real private inventories continues to go up. That's something that is people are trying to, again, balance out where things were, where some of those prices have been, and trying to get back to some sort of normalcy, given how inventories had been drained. Now, the younger consumers grow increasingly pessimistic about home buying. And this is kind of that piece of, well, who is your incremental buyer? And we keep coming back to that. And based on everything we've shown in terms of, these people are being paid the least, they're going to have the least amount that's sitting in savings to put down a down payment. How do they get ahead when you think about where do they go next and that incremental piece? So then when we look at the labor market distribution, this gives you an idea of kind of where things sit, where employment, wages continue to be at the high level, but you're still seeing some of these pressure points, especially in January, in terms of the employment population. But it does show that we are getting much closer to full employment, which again is just going to put more pressure on the Fed to raise rates. So then when you look at the backlogs in orders coming down, things are starting to get a bit better. Inventory sentiment still low, but getting better as you get some normalcy in the supply chain. So then when we look at, again, the compensation side on small businesses, roofing, while the compensation plans index is starting to come down. So they're starting to prepare for when they're not going to be able to continue to raise wages, and it's starting here. So a record 50% of small businesses raised compensation in January, yet 27% plan to raise compensation in the next 3 months, a tick down from all-time highs last fall. So again, you're starting to see that pressure come in because they're starting to get concerned about where sales are going to be over that period. While we continue to see a recovery in employment, which is, again, that wage spiral that we talk about as we approach that full employment. And then the average hourly the U.S. average weekly hours came down. This is something that, again, has been a bit elevated, but as you hire back more people, you should get this kind of spread out and back towards the previous normals. And then wages back on the rise. But again, as we've been talking about, the pressure remains on the real side and where that's going to go. And can this keep pace with where inflation is? And then when you look at the change in American financial situations over the past year, 41% of Americans say they're better off financially than a year ago, up from 25%, but below the record high of 59% in January of 2020. Identical 41% say they are worse off than a year ago. So when you look at Michigan, Michigan data, when you look at some of these leading indicators, there's going to be more pressure, and we're seeing more of that pressure again come forward. So I know we covered a lot of charts, a lot of data. We wanted to kind of get you abreast of where we're seeing things focused and move forward. But now in the next segment, we're going to go a bit deeper into Europe and what are we seeing happen in the European theater.